All right, good evening, everybody. How are you guys doing? I hope you already had your lunch, dinner, sorry. Well, still waiting for the others to come. Thank you for joining us tonight on our Investors Coffee Time tonight at 8 p.m., where we're gonna basically cover about futures trading, right? And this is actually a follow-up to a few futures session that we had earlier. We started 2 weeks ago. And you can actually see the uh, recorded videos, right? For the why the first one that we did was why most of the full-time traders actually trade futures markets, all right? And then we had actually our guest from CGS CIMB to talk to us about how you mitigate your financial risks using the futures market, and that is through hedging, right? And today we're gonna talk about how risky is trading futures, right? Now I'm sure that many of you have heard about futures, and probably you won't want to explore futures market because people think that people say that it's quite risky, right? And we also hear quite a number of negative or bad things that happens in the futures market that make people go bust and so on and so forth, right? And one of the famous one during my time was a trader in Singapore, right? Nick Leeson. I'm not sure whether you still remember. There's a movie about him called The Rogue Trader, right? And he single-handedly brought down the Barings Bank from UK, right? By trading in the commodities market. Um, so from there on onwards, people is always afraid about the futures market and always think that the futures market is very, really risky. Okay, but you know what? I've traded in the futures markets since in fact started in 1997, but just for a short while, because I only traded about 6 months before I lost everything lah, right, in the futures market. And that was because I wasn't ready, right? But I really started trading again in year 2000. That was like 2 years after that incident, right? And then I started to learn more about futures market. I learned about trading, and I learned more from futures traders themselves. And one thing that I've learned in futures trading is it is an exciting market, right? Especially for traders who wants to gain income from futures trading or from trading as their main income, main source of income, right? So they need to trade and make that kind of income possibly every month, right? So they need a very short-term product where they can make money both ways, right? Whether you want to buy or whether the market goes up or goes down, you can still make money both ways. Instead of just looking at the Malaysian stock market where you can only make money when the price go one way. And that's one of the main reasons why a lot of futures or basically full-time traders trade the futures market, because they have possibly more futures, more opportunities trading in the futures market. Right now, you have both sides that you can trade, and of course, the other thing about futures trading is also leverage, right? And because you don't need so much money to actually make a lot of money. But I mentioned before in our previous session that leverage is a double-edged sword, and that's what we wanna cover as well today, right? And see how to manage risk. Okay, and one of the reasons why, because a lot of traders lose money in the futures market is because they over traded. Okay, I'm going to talk about that in a short while so that you have another perspective on how you manage risk in futures. All right, because at the end of the day, whether you are trading stocks, whether you are trading commodities, whether you are trading forex or whatsoever, all of them involve risk, right? Most importantly is how you actually manage those risks. Okay, so I'm just going to share with you what are the risks in futures trading. Okay, there's actually a similarity between futures and stocks as well. I'm going to talk about that in a short while. But there are certain features in futures that make it a little bit more exciting, a little bit more risky, and at the same time, more potential to make more money as well. All right, but if you really want to explore into futures trading, you really need to know what you're doing. All right. So if you have any questions, just type the questions down. I'm alone today, so I possibly can answer most of your questions, especially those who are just starting in futures trading, right? How many of you think that because futures is so risky that you do not want to trade, right? Can you just type 1 there on the comment? You think that the reason why we don't want to look at futures market because is we perceive it as being risky. All right, so just type 1, right? If you already have an account, it's okay. That means you're already trading in the futures market. If you have not traded an account or you have not traded in the futures market, then this will be probably an eye opener for you guys. All right, but if the reason you are not trading the futures market is because of risk, then put 1 on the comment section. All right. Okay, so now let's go on with our presentation today. But before we start again, today's topic that we have here is basically for investment, for educational and informational purposes only. All right, it's not to be construed as any manner of investment decisions or trading decisions. They are purely educational. If you want to seek for advice, then it is best if you look for a licensed advisor. All right. So today is more on educational purposes, but basically what I'm sharing is the experience that I've gone through futures trading. Hopefully that you're able to gain some knowledge as well. All right. Okay, for those who are new with us, please like our Facebook page and also our YouTube channel to get notifications on our investors copy time. Right, whenever we have a session online, whether we live a session, that at least you're being notified. All right, so just go to our Facebook page. It's at Equity Tracker. Just like our page and follow our page and make sure the notification is on so that you are able to get the notifications. All right, and also please subscribe to our YouTube channel. Okay, if you are accessing this through YouTube, because we stream this on YouTube as well, so if you subscribe, then you also get the notification. All right. Hold on. You said I've not shared my screen, but I thought I shared. Okay. Okay. Okay, you put one means that you are not trading futures because you think it's too risky. That's what number 1 means. All right. Peter Tian, no, future is not CFD. CFD is a total different thing altogether. All right. So again, I repeat, for those who are still new with our investors copy time, we have this every night at 8 p.m. and I'm gonna basically share with you what we have tomorrow. Is a special event. It's a special session that we have today. We actually have a guest, right? You want to get notifications on our live stream or our whatever updates that we have. Please do like our Facebook page and follow us, and make sure the notification is on. So just go to Equity Tracker Facebook page and please like the page so that you get the notification, right? And if you are accessing this through YouTube, please subscribe to our YouTube channel, okay, at Equity Tracker. And once you subscribe, then you are able to get the notifications as well. All right. Okay, for those who are still new, if you want to have an access to our Equity Tracker platform, okay, just WhatsApp us at 603-8408-2070 for you to get an access to a library of financial data from public listed companies in Malaysia. And we also have analytical tools and so on and so forth for you to do a research and analysis on public listed companies in Malaysia. All right, so for you who haven't subscribed to, just WhatsApp us at 603-8408-2070. All right. Okay, now let's start today's session. Now let's take a look at some of the risks in futures trading, right? Now these risks are not only available in the futures market, but some of them are in the stock market as well. All right, so I'm going to cover basically these six type of risks, right? And then see how we can actually manage those risks in futures trading. All right. So the first one is liquidity risk, right? And basically it's trading volume, right? One of the things that as a trader, there are a few reasons why we need to have liquidity in the market. Okay, one is to get in and get out easily, of course, and the second is to basically get a very good spread when you buy and sell. Okay, so I'll talk about that in a short while. Okay, but so this liquidity risk is also in stocks, right? Because if you Not all stocks you can actually trade, because some of the stocks doesn't have much volume. You can't trade as well, right? It doesn't have much movement. So stocks do have some, I mean, not all stocks, but some stocks do have liquidity risk. Okay, so it's not just on the futures market, it's also on the stocks market. Second one is margin call or forced selling. Okay, because futures we are trading on leverage, so there is certain thing on margin, which I'll explain later. But stocks, of course, you don't have that kind of risk, all right? Because unless you're trading on margin as well, all right. But if you're trading on cash or cash upfront, then there's basically no margin call risk. Okay. The third one, of course, futures market has expiry dates, all right, and there are settlement and also delivery risk. Where stocks don't have settlement, okay, as long as the company is still listed in the company, listed in Bursa Malaysia, you can keep on holding the stock. But you cannot do this in the futures market because futures contract expires. All right, so I'll also mention this in a short while. Okay, the fourth one is leverage, right? So futures you have leverage, but stocks again, of course, if you're not trading on margin or you're not trading on a, on a collaterals to get more, to buy more shares or whatsoever, then you don't have leverage. You just do cash upfront, then it's not applicable. All right, but futures by default has leverage. Okay, number 5, we have market related risk, meaning that once you buy, you expect the market to move up, but it goes the other way around. Okay, this has got to do with all trading instruments, right, including stocks and futures as well. Right, you get the you buy a stock, you expect it to go up, but the price come down. Maybe there are some factors that affect price movements, right, that goes the other way around. Then this is basically market related risk, right? Factors that affects those prices. Okay. Number 6 will be overnight market risk as well. That means what happens if you hold your position overnight, right? I mean, like stocks as well, right? The price can actually gap up or gap down, especially gap down, because gap down is where your risk is, right? So the market can gap down, especially let's say in US markets where, let's say, Dow Jones start to crash, and then our market was probably start to panic as well the next day, and then most prices open lower. Okay, that can happen, right? But the overnight market risk will be more apparent, okay, on the futures market because you're trading on a leverage. Okay, so the difference just multiply when it comes to leverage. So I'm going to take a look at these 6, right, and then you find out that if you have certain way of managing those risks, okay, futures trading will not be as risky as you think. All right. Okay, so let's go to a very basic, right? So if you forget this, you have to go back and view our video earlier. It is called why most full-time traders trade the futures market, right? That was 2 weeks ago, so you can actually look at the recording. But I'm just going to give you a very simple trading basics, right, for futures. So in Bursa Malaysia, there are actually quite a number of futures that you can trade, all right? But the one that has most liquidity is basically the FKLI, which means the FBM-KLCI index futures, all right, which actually follows the KLCI, all right. So we can't trade the KLCI, right, because the KLCI is just an index. So if you are someone who wants to trade the KLCI, then you can look at the KLCI futures. That's FKLI, all right. And then we have FCPO, which is crude palm oil futures. Okay, this is one of the most liquid markets that you can find for commodities, right? So in FKLI and FCPO, okay, you need to have a margin to trade at least one contract. That means you will open an account. Later, I'm going to share with you how you can look for a broker to open an account. All right. You need to put a deposit in there, right? It's unlike, of course, you have to fund your trading account and then you can trade Let's say like stocks, right? But stocks, if you want to buy, let's say 10,000 ringgit worth of stocks, you have to deposit in 10,000 ringgit. All right. But for futures, it's a little bit different, right? Futures, you don't need to put the exact amount of money as the same value of the contract. Okay, you need to put in a margin. Like for example, FKLI currently you need to put a 4,200 ringgit margin as put in an account to start trading one contract. If you want to trade 2 contracts, then you have to double it up You need to put 8,004. All right, you want to trade 3 contracts, then you triple that margin. All right. But let's say we are giving example as one contract. Most of the examples I'm going to give here is basically based on one contract. So if I want to trade one contract, I need to have at least 4,200 ringgit into my account. I can start trading one contract. All right. So one contract, okay, the value is 70,000 ringgit. The contract value is, that means it's like when you buy one contract of FKLI, is equivalent, okay, to buying 30 counters in the index with the exact weightage okay, worth 70,000 ringgit. So you see that the whole value is actually, the whole contract value is 70,000 ringgit, right? But you only need to put 4,200 ringgit in. Now, how do I get 70,000 ringgit? Now, 1 point in FKLI is equivalent to 50 ringgit. Okay, that's how it's being structured, all right? 50 ringgit. So if you take the current FKLI, okay, which is 1,400 points, you take 1,004, you multiply by 50, you get 70,000 ringgit. Okay, 1 point is 50. So if you take this, like 4,002 as a margin and 70,000 ringgit as your value, then you actually get a 16.7 times leverage. I mean, 4,200 ringgit, right, as the margin, your deposit, but you can trade a value which is 70,000 ringgit. Okay, so that's the leverage. All right, so 1 point movement. Now, in futures market, there are also different months where you can trade, right? Like for example, FKLI, you can trade the current month, the next month, and the next 2 quarter months, right? So the current month, let's say it's May, right? So you can trade the May contract, the June contract, and then the September, October, November, December contract, I think. So 3rd month, right? But the most active month that most of the traders trade is the current month. So the current month is May, so it's going to be the May contract, all right? And whatever month contract will be expired at the end of the month. Like for example, you're trading the May contract will be expired at the end of May, all right? The business day lah. Okay, so that's FKLI. So CPO margin is 5,000 ringgit. Okay, just 2 weeks ago, we looked at the margin was 5,006 because price went down. So Bursa has changed the margin to now 5,000 ringgit. Okay, so this margin, the initial margin is actually set by Bursa Malaysia, all right, depending on the volatility and depending on the price of the commodities, all right. So the higher the price, the higher the margin that you require to put in. Okay, so 5,000 ringgit for CPO. Okay, to trade 1 contract. So if you're going to trade 2 contracts, you need to have at least 10,000 ringgit to trade 2 contracts. Okay, so 1 contract value is about 52,000 ringgit. Because when you put in 5,000 ringgit, when you trade 1 contract, that 1 contract is 25 tons of palm oil. Okay, the price being quoted is actually the ringgit Malaysia, right? Like 2,000 ringgit and 80 is per metric ton, 1 ton. All right, so you have to the contract size is actually 25 tons. So you take 2080 multiplied by 25, assuming that the current price is 2080 lah, right? You multiply by 25, you get 52,000 ringgit. So that will give you about 10.4 times leverage maximum. Okay, the least margin that you put in, right? 5,000 ringgit. Okay, and it will give you a leverage of 10 times. Okay, so for every single tick movement on the CPO prices, for example, from 2080, right? If it goes to 2081, that one you have to multiply by 25 because you're buying 25 tons. So 1 point movement is 25 ringgit. All right. Now the active month for CPO is the 3rd month contract. Okay, not the spot month. The spot month is current month, not the 2nd month, but it's the 3rd month. Now there is you can actually read about it why the 3rd month is being the contract that is preferred by most traders lah. All right. In fact, you can actually trade the spot month, 2nd month, 3rd month, 4th month, 5th month, 6th month, and then the quarterly months and so on. Right. They actually got a number of contracts that you can trade. Okay, so the 3rd month means what? So today is May, right? But bear in mind that crude palm oil contract futures expires on the middle of the month. Today is the 15th of May. So today the May contract is going to expire. Okay, the May contract is going to expire. So tomorrow onwards, the spot month will become the June contract. Okay, so not tomorrow lah, it will be Monday lah, right? Monday, the June contract will be the spot month. The July contract will be the 2nd month. The August contract now will become the active month contract. That means most of the traders will now start trading the August month contract because that's being the 3rd month contract. All right, so this is just the basics. I need to give you the basics because after this, we're going to work on these figures. All right. Okay, let's take a look at liquidity risk. Right now, so the reason why I brought these 2 up, FKLI and FCPO, we have of course other contracts that you can trade in futures market in Bursa Malaysia derivatives. So today we only focus on Bursa Malaysia derivatives lah, because other markets like COMEX, like CME and so on, they have their own other products, right? So we're going to talk about Bursa Malaysia products. So we have FKLI, we have FCPO, we have palm kernel oil futures. I think that one was already taken out, right? We used to have we have the FM70 as well, 70 stocks. It's like the KLCI, but this is FM 70 stocks, right? Index. Okay, but that one was also being temporarily halted because not many traders or not much volume, right? So Of course, the only way for markets to work is you need to create that awareness and create that liquidity line in the market. So, but because 𝐹𝐾𝐿I is our main index, right? So everybody is trading it. 𝐹CPO is one of the major commodities that we have. So everybody is looking at the Bursa Malaysia palm oil futures contract as a reference price globally. That's why it makes it a very important market. All right. So now let's take a look at the average daily trading volume, right? So for 𝐹𝐾𝐿I, right, the fluctuations daily, it can be averagely is about 6,002 to 10,000 contracts a day. All right. So if you take 6,002 multiply by the current 𝐹𝐾𝐿I, right? Let's say 1,370 points, multiply by 50 points. So the daily contract value that's being traded is between 425 million to 720 million, right? And that's only 1 month contract, the spot month contract. Right? And I'm not including the second month, the third month contract. No, this is only the spot month contract. So you have about R500 million being traded. All right. CPO is between 20,000 to 26,000 contracts. So there's quite a lot. Okay. So that will bring you a value of about 1 to 1.6 billion ringgit being traded daily. Okay. The contract size. Okay. So this is basically based on a 30-day and a 90-day average. Okay. The reason why I bring it to you is because if you calculate, let's say 0.1% of the trading volume, the daily trading volume, 0.1%, that's 6 to 10 contracts. Okay. So remember, 6 to 10 contracts. So if you know, there's always this rule of thumb for trading, because if you want to trade, for you to get in and get out easily, all right, and because the more contracts that you trade, all right, you may not be able to get in and get out at the same price. Right, because there may not be enough liquidity. Okay, so normally you use the 0.1% rule. So if you just calculate the 0.1% rule is 6 to 8, 10 contracts. That means there's no problem if I want to trade like 6 to 10 contracts at one go. Okay, I easily get one price or maybe sometimes two price, right? But easily you can trade 6 to 10 contracts, not a problem. But of course, you want to trade 60 contracts to 100 contracts. That means you are 1% of the total trading volume. It still is okay. You still can get in and get out, but you may not be able to get the same price. All right. Of course, you trade 600 contracts means you are at 10% of the market. That means you are a major player already. Okay. So for CPO, 0.1% is between 20 to 26 contracts. So that means there's no problem for me to get in and get out easily between 20 to 26 contracts, right? Which is quite a lot, right? See, I'm giving, for example, CPO, if you just trade one contract, the value of 𝐹𝐾𝐿I is already 70,000 ringgit, right? The value of the contract you'll be trading. If you trade 10 contracts, that means your value is 700,000. 10 contracts only, 700,000. So same thing with futures, right? Futures, one contract only 52,000. But if you trade 10 contracts of 𝐹CPO, okay, the value is 520,000. All right, so just to give you an idea. Okay, so no problem for a retail investor. Normally, we don't trade that much unless you trade more than that, then you become a major player in the market. All right. So liquidity, not much of a problem in Bursa Malaysia derivatives if you are trading with that 0.1% below that trading volume, the average trading volume. Now, second risk, right, is margin call or forced selling. Okay. I'm just giving an example of 𝐹𝐾𝐿I. Okay, when you put a margin, right, there's an initial margin, there's also a maintenance margin, right? And Bursa Malaysia, basically the margin is the same. Your maintenance margin is the same as your initial margin. Okay. Now the thing about futures trading, there's this thing called daily settlement. That means at the end of the day, right, the futures contract, whether it's whether you have position, right? At the end of the day, you will calculate your position, right? At the end of the day, and see whether your position that you have is in positive, is in profits, right, or is negative, or is in loss. All right. So if it's in loss, that means it will be basically reflected in your account. For example, right, let's say the current margin is 4,200 ringgit on 𝐹𝐾𝐿I. Okay, 4,200 ringgit. I can trade one futures contract already. Okay, and the maintenance margin is also 4,200 ringgit. In other words, every day your account has to be maintained above 4,200 ringgit. It has to be above 4,200. All right. So it also take account into your position that you hold, you open. All right. So what happens is this, right? So let's say I go long. Okay, I buy long 𝐹𝐾𝐿I at 1,400 points. Okay. That time, although the margin is 4,200, but I have 4,500 ringgit in my account. So not a problem now, right? So I basically have like, sorry, not plus 200, but plus 300 additional buffer. Okay, my account, I have 4,500 ringgit inside. Okay, in my account, so I have a 300 ringgit buffer. Okay, so what happened is at the end of the day, right? Let's say the index went down 10 points. Remember, I long, I'm expecting to go up, but the index came down. So now, because I lose 10 points, right? So 10 points you multiply by 50 is 500 ringgit in value. All right, so remember my account balance was 4,005, right? But because I've lost 500 ringgit, my account balance not really the, yeah, until you sell, then you actually reflect into your account. But like I said, because futures trading is there's a thing called daily settlement that includes your open positions, so this will be taken into account as well. All right, because if you sell right now, you're going to lose 500 ringgit, right? If you sell today at 1390, 1,390 points. Okay, so let's say at the end of the day you don't sell, okay, and you minus off 500 ringgit from your account balance. So that means your balance now is only 4,000 ringgit. Okay. So 4,000 ringgit, you cannot trade anymore. You basically have to top it up, another 200 ringgit. Okay. So that top up is called a margin. You have to make it balance back again. Because if because the thing is, this whole thing here is to actually to do two things, right? Is to protect the trader and also to protect the broker, right? Because if you don't have a margin call, imagine the next day the market just gap down even lower and keep, the trader keep on losing money because you are going against the position, then you can lose even more. All right, so there's a cap lah. So the margin there is to basically, it's like a circuit breaker, right? For futures traders. Okay. So now the thing is that if you don't top it up, if you don't have your initial margin back again, the broker actually has the right to exit your position, right? Force selling. Okay, so they can actually force sell your position so that to protect them and also to protect you also lah. And maybe you do not know what you're doing, right? So that's why the losses get bigger. So that can happen. All right. So this is basically margin. Okay. So I better, when you start to trade a futures account, of course the initial margin may be 4,002, but don't put exactly 4,200 ringgit in. All right. Maybe you have a buffer. Okay, maybe 50% more, or normally I advise just put double of the initial margin. Right, you put it, let's say in FKLI, maybe put 8,000 ringgit. Right, you put 8,000 ringgit, but you trade only one contract lah. You don't trade two contracts lah. Okay, I'll talk about that. I'll talk about that in a short while. So you need to have 8,000 ringgit, and then you trade one margin, and then you don't feel so pressure of your accounts being in negative margin or positive. All right. Okay, now the third risk is basically expiry or delivery risk. Okay, what's going to happen is this, right? Because now, let's say for example, this is today I just did a screenshot for this on the 15th of May at 3:30. Right, we have FKLI, like you see, there are different months: May, June, September, and December. So the current month is December, right? And remember, I told you the active month is a spot month contract. So if you look at the volume up to 3:30 p.m. today, is 6,400 contracts being traded. That's the highest volume. And you see, June is only 246, September, only 55. And the further it moves from the current spot month contract, the lower the volume is. All right. So if let's say I wanna go long term, right? And maybe I wanna buy let's say a September contract. That means this contract will only expire at the end of September. I can hold it up to end of September. I can do that, right? But if you look at the price may be, there may be difference in the price, which again may be a risk as well, right? Because the current FKLI, for example, you look at the current month in May, is 1,399 points at the time lah. Okay, but the September contract is 1,383. All right. So if you think the September contract, by the time in September 2020 that the index is going to go higher than 1,383, then you can buy the September contract at 1,383. All right, you expect it to go higher than 1,383. But if the market goes lower than 1,383 at the end of September and you're still holding it, then you're going to lose money. All right. One of the things that you want to look at in a very less liquid market is you look at the longer the spread will become wider as well. All right. So for example, the May one is an active contract. So there are many different kind of traders trading in a May contract. Volume is quite good, right? So when the volume is good, if you look at the buy and sell queue, you see there's only half point difference, which is the minimum tick, right? So very close. The buy and sell is very close, and the buy and sell queued volume also normally is quite a lot lah. Normally more than 15 to 20 contracts waiting to buy or sell. All right. You go further, like for example, June, you see the spread now becomes 1 point, right? 1392 buy, 1393 sell. So the spread bigger. The thing about when you have bigger spread when you buy or when you sell, right? Okay, the spread itself is actually a cost, a risk, right? Because if you buy, for example, at 1393, okay, because when you want to buy, you have to take the seller's price. The same mechanics works with the stock market as well. Okay, so I'm going to buy at 1393, but if I want to sell now, I have to sell at 1392. So I really lose 1 point. All right, by the spread itself. Okay, so if you go to September contract, you see that the spread here is now become 2 points. Okay, it becomes bigger because there's less liquidity. Not many traders are trading a September contract. The December contract is even further, about 1.5 points, right? So not that bad also lah. Okay, so the thing is that when you look at futures contract, the reason why a lot of people want to trade the current month contract because the current month is more reflective of the current index. All right, it's quite close to the index. Yeah, so you can actually trade the current month contract. And the problem is if you trade the further month contract, okay, the spread becomes bigger and you don't have a lot of volume also. Imagine you want to trade 10 contracts in December, right? And that volume that day is only 20 contracts. So if you trade 10 contracts, that means you are like 50% of the market at that time. You're a major player already. All right. So so normally people will trade the current month contract. Now for CPO, you look here, if you have the May, June, so May is expiring today. It's already expired, right? Now it's already at night, so it's already expired. Then we have the June, July. So coming Monday, the August contract will be the third month contract. Okay, you see the volume has already picked up. Okay, the third month contract today is still July, so that's why July volume is still the highest. All right, then August is catching up. By Monday, you will see that August volume will be the highest already. Okay, and then moving forward, the volume gets smaller as well. And the same thing, right? When you look at the spread, the further it moves from the third month contract, the bigger the spread. All right, the bigger the spread. Okay, sometimes it can be, but you see, you look at the FCPO, because the volume is more, the spread is actually not that big also lah. Right, 2-3 points contract, but it depends. In the morning, normally the gap is wider. Okay, but in the evening, because there are many people coming into the markets, especially after 3 p.m., then you have more buyers and sellers. All right. So you can buy so if you want to buy, for example, a whole long term for CPO, you can buy, let's say, the December 2020 contract, right, which is currently at 2185, right? So it's 100 ringgit above the spot month contract. The current third month contract is higher. That means, I don't know, maybe they're expecting by December, the price to actually go up higher. That's why the December contract is higher. Okay, this is one way to actually also give you a clue where the market is heading as well, right? But again, they can be wrong, right? This is based on the current data, but in the next few months, some data can change, and then the prices can change as well. All right. Now deliveries, this is settlement also, right? At the end of the month, for index futures, the contract will expire. Now there are two kinds of delivery, right? When the contract expires. Okay, there's one is a cash settlement. The other one is actually a delivery of the physical product. Normally commodities will have delivery, but index futures is normally settled by cash. All right, so that means it's just being squared off. No matter whether you like it or not, if let's say you buy a May contract FKLI, you hold it, right? You buy at 1004 lah. Let's say you buy at 1004, right? And you hold it until the end of May. Okay, and at the end of May, the FKLI is now at 1350. Okay, at 1350. So you have a 50 points loss, right? Okay, so automatically the contract will be will be expired, and then your position will be closed and you lose 50 points. All right. So if you're in a winning position, let's say you bought at 1004 and at the end of the month the index or the FKLI closed at 1450, you make 50 points and you think that I still want to hold lah. No, you cannot hold. All right, you have to exit your position. It will, at the end of the expiry date, it will expire automatically. So the 50 points that you make will be added to your account. Okay, but if you want, let's say, to move on to the following month, there's this thing called a rollover. All right, that means you just exit the current month contract and buy back the next month contract so that you can continue with the next month contract at any point of time. Okay, so the rollover fee, normally broker will charge cheaper lah, instead of sell now and then buy back later. All right. So now the other one is commodities, right? So for example, palm oil futures, the delivery is basically physical product. So normally as traders, I do not want to take delivery, right? So traders normally for who goes in for speculation, you only want to look at the difference in price, right? Okay. So now let's say Benny, right? I'm going to buy two contracts here. I'm buying July contract. That means the contract is going to be expired in July. Okay, because it's going to be expired in July. So I'm going to buy two contracts. So the two contracts value is 100,000 ringgit if the price is at 2,000 ringgit. All right. So let's say Alvin want to short two contracts because he thinks that the price is going to come down. So you can long and short at any point you want, anytime you want. All right. So I go long because I expecting price to go up, and let's say Alvin says it's going to come down, so that he short the market, he short the price. Okay. So on the 14th of May, the price went up to 2001. Okay. So I decided to exit. So before it expires, I can buy and sell anytime, right? The July contract is going to expire only in 15th of July for CPO. So on the 14th of May, the 14th of May itself, I say, I think enough, 100 ringgit I make, all right? 100 ringgit per metric ton. So if I exit my position, I will make 5,000 ringgit. Okay, and of course, Alvin says, I think, no, the market is not going to go up some more. It's not going to come down. Looks like it's going up. So Alvin also want to exit, and he take a 5,000 ringgit loss. Okay, so both positions, Benny and Alvin has already exited, right? That's a complete trading. Okay, now on the 14th of May, Peter, let's say, decided to buy two long contracts, and Peter, buy because he expect the price to go even higher. He buy at 2001 because that price at 14th of May that time was 2001. So he bought at 2001. Okay, and then he hold it until the expiry date. Okay, and during the expiry date, the contract price is 2,300 ringgit. Okay, 2,300 ringgit. Okay, so that means at that time, the price is 2,300 ringgit. But because Peter bought earlier a contract worth 2,100 ringgit, he actually buy cheaper than the current price in July, 15th of July. Okay, but the thing is that because it is the delivery when it's settled or when it expires, then Peter has to get ready to buy two contracts, which is 25 metric ton per contract. That means you have to buy 50 metric tons of palm oil, okay, at 2,100 ringgit, which is equivalent to 105,000 ringgit. That means he has to get 105,000 ringgit ready to buy physical crude palm oil. So you probably have to have a swimming pool somewhere to go and put the palm oil. And I'm talking about crude palm oil, not the cooking oil, right? Cooking oil is all refined ones. This is crude palm oil, okay, raw oil, all right? So normally what we do is before it expires, we will exit the position first if we do not want to take the delivery, all right, or provide the delivery or give the product, all right? So you have to exit before it expires. Okay, but normally people will not wait until very long before it. For example, you buy a July contract, you don't wait until July only you sell, because remember, the further it moves from the spot month contract, the lesser the volume becomes. So your buy and sell spread can be big already. Okay, so you will not be able to get the price that you want. Okay, so the best is actually to roll over. All right. Okay, so for those, again, you want to get notifications from Bursa Malaysia or whatsoever, for their notifications for live webinars, for some information, please do like their, just go to their Facebook page, Bursa Malaysia Derivatives, or their Instagram, also Bursa Malaysia Derivatives. Now we're going to put a comment there on a comment section on a post, so that you can also go into their website and like their page, all right? Like their Facebook, okay, like their Instagram, and follow them on their LinkedIn, so that you get more information for them from Bursa Malaysia Derivatives. Okay, because this year I think they're going to launch a few products, and one of them is actually the single stock futures. All right, so just go there to get notifications and updates from them. All right. Okay, I'm going to go to the fourth one. This is the most important and biggest one, right? Risk, which is leverage. Okay, leverage is basically a double-edged sword. Okay, before I go there, let me try to see some questions. All right, if you if you have any questions here. Any recommendation of trading future forex and all futures? That one you have to go and search yourself, because I don't trade forex, I don't trade oil, so you have to go and look for someone else lah. Any proven strategy? Proven means what? Okay, that means you buy show win one, William. No, it requires, it's the same thing like how you invest stocks as well. You need to have that knowledge and skills. You have to build that up first before you can actually start trading futures. But you need to understand the futures product first. And that's the reason why we are here today, right? To understand the product, to understand especially the risk so that later you know whether this is for you or not. All right. What will happen if 𝐾𝐹 contract expire? I already explained. So that thing will be settled in cash. All right. So if you make money from your trading, that that money will go into your account. If you lose money, then it will be deducted from your account automatically. Okay. Tan Wei Xiang, can you explain how the current price, for example, 𝐹𝐾𝐿𝐼 affect the price of contract that 2-3 months away? I already show you the price, right? The further it moves, it is the price will be different. So it depends on the market one. All right. Please explain the difference between 𝐹𝐾𝐿𝐼 and FBM KLCI, EA and KLCI. Now, ETF and 𝐹𝐾𝐿𝐼 is different, right? ETF is like trading stocks, right? And it's being managed actually by a fund manager. So you buy, and there can be a unit price, right? So when you're buying ETF, you're buying a fund, right? It's like buying a fund, so it's different. You buy a 2x, for example, you only get 2 times leverage. Whereas futures, there's just, I mentioned to you earlier, if you put the minimum initial margin, you get about 16 times leverage. That's much higher. All right. So again, ETF is any ordinary ETF, right? It's an exchange traded fund. Okay, futures is a different market altogether. Does that mean that the maximum I can lose in one contract is 4,005? Sometimes it can be more lah. Okay, especially if you're trading more, right? You can be negative if, let's say, the market gap down like crazy. I show you how later on. Lim Kong Xiao, I'll show you some of the mechanics later on. What factor you consider my whole position overnight? So I'll talk about that because I haven't come to the overnight risk yet. In news, actual commodities market influence the CPO, or is it merely trend falls that push market up? Yeah. Commodities like index also is all because of many factors, right? It can be economical factors, it can be demand and supply factors, right? And one of the reasons why a lot of traders use charts is because charts is leading, is faster, all right? When you want to wait for economic data on news and so on, by the time those data come out, the price has probably been already factored in. Okay, and that's the reason why a lot of traders like to use prices. Okay, because if you look at fundamental data, it's a little bit too slow to make short-term decisions. All right. 𝐹𝐾𝐿𝐼 trade longer than KLCI, start 15 minutes earlier and later. Is there a discovery time and closing gap? How to take advantage of both? Which is leading and why? Now you have to do research sometimes. All right. Normally, the cash market, which is the FBM KLCI, leads the 𝐹𝐾𝐿𝐼. Right, but now futures traders, because it gets more complicated, people get information faster, right? You can actually, sometimes you see that the 𝐹𝐾𝐿𝐼 may lead the FBM KLCI, but not much difference. They can be wrong also, all right? Because remember, when people make decisions, it's all based on their own hunches, their own decisions based on the information that they have, all right? But normally it's quite close. For example, if let's say 15 minutes before the market opens, you are right to say that the 𝐹𝐾𝐿𝐼, the 𝐹𝐾𝐿𝐼 or the KLCI index futures open at 8:45, 15 minutes early before the market opens, right? And normally, if the market, let's say the 𝐹𝐾𝐿𝐼 goes down 5 points, right? The 𝐹𝐾𝐿𝐼 or the cash market KLCI, FBM KLCI will go down 5 points. But again, it's not necessary because it depends also between the discount between the 𝐹𝐾𝐿𝐼 and the KLCI, all right? So sometimes the KLCI or 𝐹𝐾𝐿𝐼 can be lower than the KLCI. Okay, but so if you read too low, right, it will not lead lah. So normally you follow back the KLCI. So it really depends. Okay, it's not necessary that one leads another. No, there's no sure statistic that says one lead another. Okay, futures and options now. Futures and options are two separate different things, right? Futures, you actually, by definition alone, futures, when a contract expires, you have an obligation to buy, to deliver the product or services, all right, to deliver the physical products. Options, you have an option. Okay, so you can just, because and options are cheaper, right? So you can actually say, I don't exercise my option lah, just take the risk, all right? Just forget about it lah, right? Then you lose how much options that you buy. Okay, so again, just go to Bursa Malaysia Derivatives page. You should be able to see options there, right? How they explain about options as well. Any plans to cover arbitrage? Now, there's spread trading in futures trading, but not much of an arbitrage, because arbitrage normally, if one product is being traded in 2 markets, right? So of course, for example, KLCI index futures is only traded on one market. Okay, CPO, not only one market, but you can also look at some other markets like, China, Dalian, but the contract specs are different. All right. Because in China, they trade palm oil, which is processed, whereas ours is crude palm oil, but you can do some lah. Okay. So normally you don't, there's no other exchange there's which has enough liquidity for CPO futures or crude palm oil futures. Futures and options are two totally different contracts, right? So just go to Google, you can find out what's the difference. Okay, I was thinking of subscribing to TradingView to get access to live charts and paper trade for the time being. For the time being, I think TradingView is a good platform. Everything is there, right? And it's one of the cheaper ones as well. Does it happen when the CPO price go against the future month's contract? Yes, it can. All right, because the further, some people have short-term view, some people have short-term, longer-term view, right? So those who have longer-term view may have a different view on prices. Okay, I already shown you earlier, the prices, right? For palm oil futures, you look at even at September contract itself, the difference is 100 ringgit. That means they are more bullish. The price 1 ringgit, 100 ringgit higher than the third month contract future. All right. So that means they're expecting the prices to go up in the future in September. Okay. But then again, they may be wrong, right? Because when data comes in, when the new data comes in, you can see that if the September price may be 100 ringgit higher, it may start to go down also. Okay. Okay, what charting software do you use to analyze futures market? Like I said, today you can use TradingView and so on. If you do the subscription one, you get live. You get the free one, is 15 minutes delay. All right. So the one that I use is called NextView Advisor Professional. All right. It's real time. It's not web-based, it's application-based. So for me, I prefer application because it's more robust. All right. So that's my preference. And then you have Bursa Station, you have other, Share Investor and so on. These are some of the options that you can look at as well. All right. Okay. Now I'm going to go on. Leverage, right? So now, your maximum leverage that you can get in trading, let's say futures market, is your contract value over your margin, your initial margin. All right. Of course, you can set the leverage yourself by putting in more money into your account. Okay. For example, right? So I give you 3 examples. Okay, the first one is basically where your account balance is 4,200 ringgit, which is your margin, your initial margin, right? Remember for FKLI, so I'm giving an FKLI example. FKLI minimum margin is 4,002, right? So the contract value at 1,400 points, right, is 70,000 ringgit. How do you get 70,000 ringgit? 1,004 multiplied by 50 lah, so you get 70,000 ringgit. All right. So you put in 4,200 ringgit, immediately you can start trading one contract, and that one contract is worth 70,000 ringgit. Okay, so you take 70,000 ringgit divided by 4,002, you have a 16.7 times leverage. Okay, so you think, wow, 16.7 times. That means if the market goes down, let's say 2% lah, right? Just 2%, right? So 1,004, 2% means how much? 28 points, right? Okay, so you just go out 28 points, which is 2%. Okay, so you take 2 times 16.7 is about 35%. That means your balance that you have there can go up 35% or go down 35%. All right, just by 20 points more. I give you more examples in a short while. Okay, but if let's say you put a balance of 20,000 ringgit, put in your account, so 4,002 is the minimum, right? But you put in 20,000, but you by right 20,000 contract, you can probably trade about 4 contracts. Okay, but you don't trade 4 contracts, because if you trade 4 contracts, your leverage still about 16 times. Okay, but you trade 1 contract only. Okay, 1 contract, which the value is still 70,000 ringgit. So now, because your balance is 20,000 ringgit and you are trading a contract worth 70,000 ringgit, that means your leverage now is only 3.5 times. All right, by putting in 20,000 as your balance or your account where you want to trade only 1 contract. Okay, because the contract value is 70,000 ringgit. Okay, now if you put in 70,000 ringgit, which is equivalent to the current value, that means you got no leverage. Like you put in 70,000 ringgit and you are buying a contract worth 70,000 ringgit as well. Okay, so that means it's like buying a basket of shares worth 70,000 ringgit at current price. So you are treating the 𝐹𝐾LI as like a one single share that you buy. Okay, you can do that, isn't it? Okay, you have a 1 times leverage. So you put in 70,000, you just trade one. Okay, so it's like buying a portfolio of 30 counters. All right. Yeah, so you can, so the balance that the account balance that you have will determine what kind of leverage you have. Okay. Now, there's this thing that of course a lot of people mentioned that one of the things that 𝐹𝐾LI is may not be so, or CPO or index futures and commodities futures may not be as risky as stocks, is because let's say you treat it as like buying one share, no leverage, right? No leverage. Now 𝐹𝐾LI currently is at 1,400 points and CPO is 2,000 ringgit 80. Okay. Now, do you think that 𝐹𝐾LI and FCPO can easily fall 50%? Meaning, meaning the 𝐹𝐾LI actually now go down to 700 points. Do you think it's easy to go down to 700 points? Okay. Or CPO goes down from 2,080 to 1,040, 50%. Quite tough, isn't it? Because they are index, right? KLCI and commodities. I mean, if you go down to 1,040, I think a lot of palm oil producers are going to close shop already, right? So there is certain cost. And for those who want to know what are the factors that are affecting CPO prices, right? Join us next week. We're going to have one more on the 20th of May. Where we're gonna talk about the factors that's affecting CPO prices. All right. But stocks can easily fall 50%, right? I mean, you look at even just recently when the COVID-19 came and we have the MCO of stock prices gone down more than 50%, 60, 70% easily. Okay, but index don't go down easily 50%. So if no leverage at all, you find out that index, okay, or commodities is actually less riskier than stocks because they don't fluctuate that much. All right, but because of leverage, that's why it's being more risky. Okay. Okay, so one of the things that we'll look at is your trading risk, right? But before that, let me just share with you a bit. Okay, I actually have this spreadsheet over here. We have the left hand is 𝐹𝐾LI, the right hand is FCPO because of the contract spec difference. That's why I separate them both. All right. So now you look at number one here, the first one. I just look at 𝐹𝐾LI currently. Okay, 𝐹𝐾LI. So the margin is 4,002. Okay, so if I put in 5,000 ringgit, that means I can trade only one contract, right? Only one contract. If I put 6,000 ringgit, I can also only trade one contract. If I put 7,000 ringgit, I can only trade one contract. Okay, if I want to trade two contracts, then I have to put 4,002 multiplied by 2. I need to put 8,400 ringgit for me to trade two contracts. Okay, so let's say my account balance is 100 sorry, 5,000 ringgit right? 5,000 ringgit, I put in contract, and let's say I go into a long position, right? Okay, current price at 1,004 and trading one contract. Okay, so the current contract value is 70,000 ringgit. Okay, that means with 70,000 ringgit and my balance is 5,000, my deposit or my capital there is 5,000 ringgit, I have a 14 times leverage. Okay, so let's say if 𝐹𝐾LI goes to 1,450, 50 points. Okay, I will make 50 points. Okay, so the contract profit, you take 50 points multiplied by 50. Remember, 1 point is 50 ringgit, right? So 50 times 50, you get 2,500 ringgit. So you actually make a profit of 2,500 ringgit. Okay, remember your balance of account is only 5,000 ringgit, right? And you make 2,500 ringgit when you make 50 points from the 𝐹𝐾LI. Okay, so 2,500 from your account balance, 5,000 ringgit. That means you have made 50% from your account balance. So your account balance now become from 5,000 ringgit becomes 7,500 ringgit. Okay, so the market only moved 3.6%. Okay, the market only moved 3.6%, but because it's 14 times leverage, you get almost a 50% gain on your deposit. All right. So if I'm going to put in come on, let's say I put in a 20,000 ringgit account balance, 20,000 ringgit lah. Okay, the market still moved the same, isn't it? 50 points. All right, 50 points, 3.6%. Okay, but the profit is also the same, 2,500 ringgit, 50 points. You are trading one contract also, same one contract, right? But because you have put bigger account balance here, 20,000, so 25,000 against your deposit or your capital of 20,000, you actually make 12.5%. Okay, so the more amount you put here, of course, you trade the same amount, which is one contract, your percentage of profits against your capital will be smaller as well. Okay, but of course your risk will also be smaller, right? Because if you let's say if the FKLI now goes to 1350, right? Okay, 1350. Now you're going to lose 50 points. So you lose 2,500 ringgit from your 20,000 capital. So you still have 17,500 ringgit to go around with. Okay, and you lose 12.5% of your capital, right? If I put, let's say, 40,000, okay, then if it's 50 points, I only lose 6.3%. Okay, so the leverage is basically depending on how much you put in now, right? So if you are someone who thinks that the leverage is too big, then you can always increase your balance. Okay. Okay. Now the other thing is this overnight risk, right? I'm just going to mention this a little bit because I also mentioned this in our first session that we did on the futures market. Overnight risk means, there's a risk when the market closes and when it opens tomorrow, because anything can happen in between, right? For example, let's say CPO, right? CPO closed at 6 p.m. and the next day open at 10:30 a.m., 10:30 a.m., right? So anything can happen, especially the substitute product for palm oil, which is soybean oil, all right? Or crude oil prices can also affect palm oil prices because of biodiesel, all right? Or the US dollar can also affect prices. Okay, so there is overnight risk. Okay, and because of these factors, it's going to affect when the market close. The next day, the price can factor in this news or this information, so the market can gap up or gap down. All right, so there's this overnight risk when you hold your position overnight. All right. Of course, there's market risk. Market risk is basically the same lah. Is when the market moves the opposite direction of your expectation because of different factors, then the market risk is available in any instrument. All right. Overnight risk also available on any instrument. Okay, but for futures, it's more obvious because you are trading on leverage. All right. Now, for example, okay, CPO, especially CPO, normally got very big gaps. All right. And there's actually a way to manage this lah, right? So let's say I'm gonna go long at 2244. That means I'm expecting the price to go up, right? I'm expecting the price to go up, and then at the end of the day, okay, the market closed at 2230. Okay, now this is my strategy, right? I'm gonna go long at 2244. I'm gonna put a stop loss at 2220. All right, so that means my risk is 24 points. Okay, 24 multiplied by 25, that's 625 ringgit. Okay, 625 ringgit. So that's my expected risk, isn't it? So if the price goes down to 2220, I'm gonna exit my position and take a 625 ringgit loss. All right. Okay. Now the market closed at 2230. So 2230 haven't hit my stop loss at 2220. So I decided to bring it overnight. Okay. Now what happens is the next day you see there's a very big gap down here, right? 2230. The market opened at 2173. Okay. I'm going to open at 2173. So what happened here? Instead of, I already prepared to lose 625, but because the market gap lower and that's now 2173, I incur a 1,775 ringgit loss instead of 625. So my risk, my stop, my theoretical stop was there, but it wasn't hit because the market opened way below my stop. And then I exit. If I exit there, I'm going to lose 1,775. Okay, that's overnight risk. All right. So if I want to do an overnight trade, right, that means I want to hold overnight, I want to make sure I have to take account into the volatility of the market as well, right? Considering there are gaps in between, okay, overnight, I need to take account. I cannot put a stop loss that is too small, like what I did in CPO. I put at 24 points. Next day, the market gap down 70 over points, gone. All right. So I need to look at what kind of level that I can put a stop loss so that I won't get stopped out because of this risk. Okay, so one of the ways to do it is to look at the range, the trading range. For example, CPO has about a 60 points range. Okay, if you're trading one contract, 60 points is basically about 6,500 ringgit per contract lah. Okay, 1,500 ringgit per contract. So if I put a 60 points, fluctuation is about 1,500 ringgit movement per day, right? FKLI daily volatility is about 18 points. Okay, it's about 18 points. So that's 900 ringgit. Okay. So now, if I put a stop loss that is lower than 60 ringgit for CPO, right? If lower than 60 ringgit, then I will get easily stopped out. Why? Because that's the normal range. It's been trading like this 60 ringgit every day. So if I put less than 60, I can easily, if I put more than 60 ringgit, that means tomorrow, let's say the market gap down 20 points or 30 points, I'm already expecting it. That means I can still hold. Okay, so the thing about if you want to hold your position overnight, okay, your stop loss has to be bigger. That means risk have to be wider as well, right? But the thing is that if your risk is wide, you make sure that you have a good potential profit to make at least double the risk that you have, lah, right? It seems the application in trading decisions is the same, even for futures, right? So, but we need to have this, right? 60 ringgit at least, right? For CPO. For 𝐹𝐺𝐻𝐿𝐼, you put anything that's below 18 points as your stop loss, you can easily get stopped out as well. All right. Okay, so now I know we're already running out of time. I'm just going to do a conclusion, then I'm going to come up with questions. All right, I'm going to answer your questions. So basically, we have the 6 different kind of risks. How do we manage them? Okay, how do we manage leverage? Is you set the right amount of capital in your trading account. That means your account balance have to be right, and it depends on individual traders. If you can take bigger risks, then you try to get more leverage. If you cannot get more leverage, if you cannot take a lot of risk, then go for lower leverage. So how to get lower leverage? You increase the amount into your trading account, but you trade the same contract, number of contract. All right. So liquidity, how you can get out easily is you don't trade excessively. All right. So if I already give you the figure earlier. If it's 0.1% and below from the average daily trading volume, then you will not have any problem going in and going out. All right. And also trade the current month contract, which is easier because if you trade the further month contract, the price difference may be a lot, right? And then it's very hard to manage the risk. So it's better to actually buy the active month contract, and if it's going to expire, just roll over to the next month, all right? Because the cost of rolling over is probably just 1 point, all right? 1 point, that's all. So overnight market risk, so do not set a stop loss which is too close or too small, right? Make sure it's at least bigger than the average range. Then you'll be safer. Okay, so of course you put a bigger range, that means your risk will be bigger lah. But when your risk is bigger, you're expecting to make much bigger profits. All right. Market risk is like any other risk. You need to have a trading plan or a strategy, right? Or whether it's investing, whether trading, you need to have the right skills and knowledge to come up with a trading plan. Okay, that's the only way you can manage your risk, market risk. All right. Make sure you have enough buffer to avoid margin calls. Okay, remember I told you the margin call, you don't want to get that call from your broker every time when you are below your maintenance margin, right? So normally if you want to trade in the futures market, you want to trade minimum 1 contract, make sure you just double up the initial margin, right? So if it's, for example, palm oil futures 5,000 ringgit to trade 1 contract, don't put in 5,000 because that's just the border, right? That's just the minimum. Put in 10,000 ringgit, okay? But trade 1 contract, so then you have that buffer. Okay, so number 6, you trade active months contract to manage higher costs, which I just mentioned to you earlier. All right. Okay, so before I answer your questions, let me just make some announcements first. I hope today's session, I know it's quite a lot, okay, for you to digest. But what I'm going to do is I'm going to provide these slides onto our WhatsApp. Later, I'll show you again the same WhatsApp number. Just go there in the next 1 or 2 hours. You should have these slides on your on the WhatsApp. All right. So again, go to Bursa Malaysia Derivatives, right? So search Bursa Malaysia Derivatives on the Facebook, Instagram, and LinkedIn, and subscribe and also like them so that you are able to get notifications from them. Okay, and they also have a lot of information there, right? Or you want to get other information for futures trading, just go to Bursa Marketplace, right? Click on the button that look like a hat at the top there, right? And then click on Start Futures. That will give you an idea about futures market, right? That's where they explain. Okay. If you want to open a trading account or want to know where to open a trading account, just go to Bursa Marketplace as well. Let's go right to the bottom and click on the Open Trading Account, right? On Bursa Marketplace. Go right to the bottom, click Open Trading Account, and then click on Derivatives over here. So just fill in your name so that and select your preferred broker so that the broker will contact you and guide you how to open an account. All right. Okay, so tomorrow we have a very special session. This is from Yong Chu Yu, who is actually a managing partner of Money and Life. He's a certified financial planner. Okay, he basically teaches in the financial industry. He's a financial planner. So he's going to talk about the loan moratorium, right? remember, we actually get a 6-month loan moratorium, right? So the question is, should you take it or leave it? All right, so we're going to weigh the pros and cons and what are the other benefits that you can get from this, okay, which is provided for you during this lockdown. Okay, so join us tomorrow at 8 p.m. Okay, and then you should be able to ask questions and ask Choo-Yu here questions, right, on whether you should take it or you should just leave the loan moratorium. Okay. Tomorrow, this is for our members. If you this is to remind you guys that the Mandarin session actually have an equities club meeting only for members, right? And if you're a Genius member for the Mandarin Genius member, you should be able to access this as well. All right. So again, for those who want to know how to be a member of Genius, just WhatsApp us, or you can even call us, right, at 8408-2070. Okay, I repeat, 603-8408-2070. Okay, so again, and those who wants to subscribe to our Equities Tracker platform, just WhatsApp us at 603-8408-2070. And this is the number where you can also download the slides for today. All right, just WhatsApp this number and just click on English freebies, and you should be able to see today's session, right? Is futures trading risky? Today's presentation slides. All right. Okay. For those who want to join us in our Equities Tracker online tutorial or online workshops, where you can learn charting, and of course, some of you are asking how to trade futures and so on. One of the things that we actually teach you in our ET online campus is chart price analysis or price chart analysis. All right. So join us at charity.equitiestracker.com. All you need to do is to do a donation, right, to any charity, and just click on to charity.equitiestracker.com. Pledge a minimum 100 ringgit, and you can join us for free, and you can also bring 3 friends in. All right. Okay, so I'm just going to answer your questions now before we end. We're going to have our Mandarin session in 5 minutes. Okay. I hope I'm not going too fast as well, because I'm expressing quite a lot of things today. If KLCI dropped from 1,400 points to 0 points, if I short one contract and I put 10,000, does that mean I will lose only 10,000 or 7? You will lose 70,000, okay? Because remember, there's a daily settlement, right? If you keep on holding it, you have to top it up, and you have to maintain your margin at 4,200 ringgit all the time. Okay, so you still lose 70,000 ringgit. All right, if it goes no need go to zero lah, right? If it drop see 50, 100 points times 50 is already 5,000. So it needs to drop 200 points to wipe out all your capital, 10,000 ringgit, right? What other indicator do you use to trade futures? One of the tools that I use to do is basically if you go to our ET online campus, I teach the same thing. You can apply the same thing there. Okay, but of course for intraday trading, there are different tools that I use lah. Okay, I used to do intraday trading a lot, but not much anymore. All right. Daily volatility for CPO and FKLI. Which one is RM and the other one is points? Index is points lah, right? Commodities like CPO, because it's quoted in ringgit, so that's why it's RM. Okay, so index, there's no RM, right? So it's in points. Okay, but whatever it is, you just put in, you multiply 50 for FKLI to get the RM value. Okay, and to get a contract size value for CPO, you multiply by 25 for the current price, because you're buying 25 or selling 25 metric tons. Where to get info for average gap up and gap down trading range? Okay, you just look for, you go to any charting tool, you just apply average true range. Okay, then you should be able to see, because average true range take account into the gap as well the previous day. That's why I use average true range. If you just calculate the range, it only calculates today's high and low range. All right. Will I upload the Excel that you just shared just now? Okay, maybe you PM me lah. Okay. If you guys want that Excel spreadsheet, just PM me, add me on my Facebook. Then ask me for the Excel, I can give it to you. All right. Okay, let me see whether there are any questions for YouTube. What's the difference between futures and bonds? Wow, futures and bonds are 2 different things lah. Of course, there are bonds futures as well lah. Okay, like for example, in Bursa Malaysia, you actually have the MGSS, okay, the Malaysian government security. which is a bond in the futures market as well. Okay, so but of course, bonds and futures are two. Bonds are basically like loans, right? So it's different from the futures market. Okay, will you be teaching options too? No, we haven't covered options because I mean options currently in the US market there is, but Malaysia is still quite new. I don't trade options, so I do not know. Okay, Hari Chandra, is the structure for 𝐹𝐺𝐻𝐿𝐼 the same as stock futures offered? No, every single futures contract has a different specification. So you can find all this information on Bursa Malaysia's or Bursa Marketplace, or you go to the Facebook of Bursa Malaysia derivatives. You should be able to see this information. Do you have a futures trading class? Not yet. I do teach the futures trading, but that's during before the MCO lah. But now we don't have yet. Right? I used to do intraday trading, but I don't anymore. I'm not sure. Right? I've not teach them for quite a long time. So it depends on if you guys are interested, then you just say you're interested. Maybe just put a comment into our Facebook page. Then maybe we'll start a futures trading course. Right? Okay, so guys, I guess that's about time. We're gonna start our Mandarin session soon. So please do join us our Mandarin session, which is going to be at 9:15. And thank you very much for joining us. And I hope that today's information will be good for you to at least look at futures trading. Like I said, it's all about how you manage futures trading, right? Because the good thing about futures trading is you can make money both ways, right? Whether market goes up or goes down. Okay, leverage is additional, but you need to know how to manage leverage, and of course the other risks as well. So I hope you all the best, and I hope that you are also be able to consider the futures market as one of the trading instrument for you to accumulate your returns on your investments. All right. So thank you very much, and have a good evening.